Good morning, everyone, and thanks for joining me for the presentation on the Secure Act. Just a few notes. We're going to really walk through. Well, first, my name is Russ Austin. I'm the Associate Vice Chancellor for Plan Giving at WashU. I joined WashU about a year and a half ago from the University of Wisconsin, and so thrilled to be here and thrilled to present on a topic that I'm passionate about. And how the Secure Act will impact wealth transfer, especially I think with physicians. So I'm gonna quickly review, some background information on why I think the Secure Act will impact physicians. I'll talk about the Secure Act, the rules, the law, and how it will impact wealth transfer. And then we'll spend a little bit of time on the CARES Act and finally the Biden tax plan. So if you have questions, please feel free to put them in the chat, and we may have some time after the presentation as well if you have questions. All right, so again, I want to start out with building some context here. And so Medscape Physician Wealth and Debt Report came out in 2019. And they surveyed about a little over 19,000 physicians across 30 specialties between October 2018 and February 2019. And a few of those survey questions were related to wealth and investment and retirement accounts. So if you look at this slide, from 60 to 64, 65 to 69, and 70 or older, about 75% of physicians will have a net worth of $1 million or more in that age category. And certainly depending on the specialty you're in, that will obviously depend on the wealth building. But it's something I'm sure we all know that physicians have a higher net worth than the average, but it was nice to see this in the report. Second thing we know about physicians, and I know this firsthand from working with so many, is that physicians never retire. And this just shows that the average person retires at the age of 63, while physicians intend to retire at 68. So, obviously what that means is their wealth grows, the retirement account wealth grows longer, and certainly there are a number of physicians who retire well past 68. And then finally, the survey asked about how much money do you put in taxable savings account each month? And the respondents showed basically from about 55% put between $500 and $2,000 a month into a retirement account. So, what we know is many physicians work for universities or obviously work for big hospital systems that also contribute to their retirement account. Given that physicians work longer, this typically is a pretty big resource for physicians and a portion of their net worth. Okay, so let's talk about the Secure Act. The Secure Act was passed in 2019, and it did a couple things. One is it raised the minimum distribution age to 72, so that gives people a little bit longer time to grow grow their retirement account. It also provided a catch-up distribution as well, and it also allowed individuals to contribute to their retirement account after age 70 and a half. Prior to that, you couldn't do that. But the biggest change it made was the creation of the 10-year distribution rule. So previously, if I inherited an IRA, I could stretch that payment over my lifetime. So if I inherited an IRA from my parents at age 50 and I lived to 90, I could stretch that required minimum distribution over 40 years. And the government has basically said, listen, retirement accounts are never meant to be for wealth transfer. They're meant to support you in your retirement. And so if you think about it, when you are contributing to a retirement account, if it's pre-tax, you're delaying the taxes already on that. And then with the stretch rule, the government was taking a long time to get their money, if you will. So they decided we're going to eliminate that stretch IRA and we're going to create the 10-year distribution rule. And this is where the impact I think on physicians will have. Distributions must be taken over a 10-year period following the death of the plan owner. So given that, if I inherit $1 million IRA from my parents, I have to take that within 10 years. I can take it all in year one. I can take an equal amount over those 10 years, but it has to be liquidated by year 10. And keep in mind, retirement accounts, pre-tax, are all taxed at ordinary income. And so what I've seen with physicians is typically they leave money to their kids. Their kids are usually pretty successful. They're either physicians or attorneys. And so they're already in a high tax bracket. And so they're going to pay significant taxes on that distribution now. And if your child or your beneficiary lives in California, there's an additional 11% tax on retirement account. So, $1 million IRA left to a child who resides in California, they're going to pay 50% tax on that. And so they're only going to receive, in that case, 500,000 of the $1 million. There's a few ways to get around this, and there's very few. And that's what we're going to talk about. We're going to spend the focus of our time talking about the last one, the testamentary charitable remainder trust. But there are a few other ways. So one is you can name one or multiple beneficiaries of your IRA. So it's a beneficiary designation form. You can simply, list a percent payout to a charity or a dollar amount. All of that money goes to charity. There's no tax on that. Second is a qualified charitable distribution, meaning at age 70 and a half, you can give up to $100,000 a year to charities and not pay taxes on that. So if your required minimum distribution is $100,000, if you directly give that to charity, you pay no taxes on that. So we always recommend when people reach this age, if they are going to make charitable contributions, they should think about donating from their IRA first. And then last, and this is the important one, is a testamentary charitable remainder trust. Most folks, again, the IRA could be a big portion of their net worth, and they want to leave some portion to their kids. And the only way to do that and lessen the taxes is through a testamentary charitable remainder trust. So a testamentary charitable remainder trust means that the trust is completed upon death. So in this case, a IRA beneficiary designation would be to a charitable remainder trust. And we're going to go over an example of that. And upon the donor's passing, those retirement assets move over to the trust. Now, the nice thing about this is it can be managed by your financial advisor, or it can be managed by a charity like WashU. We create charitable remainder trusts all the time, and we can manage the money and distribute it out. But it can be managed by a financial advisor, and the trust can live with them. So the benefit to this is that you can leave money to your heirs in the trust so that they receive an income for up to 20 years. And so in the case we're going to show, if you had an IRA worth $1 million and you created a testamentary charitable remainder trust, and that IRA money went to that trust, the full $1 million goes into the trust. There's no taxes on that. And then a percent payout will go to one or more beneficiaries. And the percent payout it has to be fixed at the time the trust is set up, but it can be 5, 7, 8, 10%. It just has to meet the 10% IRS remainder requirement, meaning 10% of the original value has to be left to go to charities. And then when that period ends, let's say it's 20 years, then that money then is given to one or more charities. So again, the assets are transferred tax-free, which is wonderful. And I'm going to walk through an example in a minute. One thing we always talk to donors about is, really what you want to achieve with your estate. And I think for many folks, this is one of my favorite quotes. I think it's a Warren Buffett quote. I want to leave my heirs with enough to do something, but not enough to do nothing. And so the testamentary charitable trust is really a way to leave your heirs an annual income that they can use it every year. They use to buy a house, they can use for other things, but they can't blow it all in one. It's also really good for people who have a child with a disability, who would prefer that that child receives an annual income versus a lump sum. So let's walk through an example of what this looks like. So here's our assumptions. This is it's $1 million IRA, and in one column it's left to a child or an heir, and in the other column it's given to a charitable remainder trust. We assume a 6% rate of return for both scenarios, a 5% payment or withdrawal for both scenarios. The highest tax bracket, the trust in this case is a 20-year term. And again, remember, a donor's financial advisor may manage the money. So in column 1 is our testamentary charitable remainder trust, and column 2 is the IRA left to a child. You'll see the value is $1 million, but you'll see, and we're going to assume that the child takes the income in year 1, or liquidates the IRA in year 1. That's going to put them into the highest tax bracket. They're going to pay $370,000 in taxes on that IRA. So what's left to invest for the child is $630,000, while what's left to invest when the money goes to a charitable remainder trust is the full $1 million. And then the 5% payout rate would be $50,000. Keep in mind, typically the payout rate is based on the market value of the fund, so that could go up or down each year depending on the market. And versus if the child withdrew 5% from the $630,000, that's $31,500. Now, there are taxes on the distribution of the charitable remainder trust. That is taxed as ordinary income, and versus obviously the IRA to the child, when they take money out, that'll be taxed as capital gains. So the difference really is with the charitable remainder trust, the child's getting about $7,000 more after taxes through the trust than by taking their 5% from their investment. You can see the total payout is about 1.1 million versus 700,000. And then at the end of 20 years, that 1.2 million that is left can go to one or more charities. Now, I always tell folks, you have to be charitable inclined to do this, because as you see in the end, after 20 years, that child still has $800,000 left with a 6% return and a 5% withdrawal. So you have to be charitably inclined first, because in the end, the money is going to go to charity. But if you are, this is a really wonderful way to support a family member, minimize the taxes, and then obviously support a charity or charities. You can support multiple charities through a charitable remainder trust. In addition, you can support multiple beneficiaries. So it could be one child that receives this income. It could be 10 people that receive this income. And it doesn't have to be children. It could be anybody. So there's lots of flexibility. I've seen charitable remainder trusts where it's a 12-year payout and it's 15%, and it meets the 10% rule. So for 15 years, there's going to be or for 12 years, there's going to be a 15% payout on that trust. And then at the end of that time, the trust collapses and goes to charity. So there's very few ways to minimize taxes with wealth transfer with an inherited IRA. The ones I mentioned are a few of those to try and minimize the taxes, and also in this case to support an heir. Quickly, just so you know, the CARES Act, which I'm sure you're all familiar with, was passed in 2020 as part of the COVID economic relief plan. Just a couple things from this to share. One is that it was extended in December of last year, and so for 2021, you may deduct with cash gifts. You may deduct up to 100% of your adjusted gross income for this year alone. So if you have pledges out there or you want to support a charity, boy, this is the year to do it, because you can donate cash and deduct up to 100% of your adjusted gross income. So if your adjusted gross income is, for easy math's sake, $100,000, you could deduct up to $100,000 of cash gifts. Most likely this will go away at the end of this year, but it is in place until at least December 31st. And there's still the 5-year carryover that applies. So you can deduct up to 100%. If you can't, if your charitable giving is beyond your adjusted gross income, you can carry that forward for up to 5 additional years. Last, I want to touch base on the Biden tax plan, because this will have a significant impact on physicians if some or all of these provisions go through. As you may know, the Congress is trying to pass a $3.5 trillion spending plan, and to do that, they have to pay for it. And so in the potential tax law changes that Biden has proposed, it would raise the top rate from 37% to 39.6% for taxpayers that exceed $400,000 in income. It would also increase the capital gains rate from 20% to almost 40% to that 39.6% on earnings of $1 million or more. So significant change to that. And the also thing it does is that it would eliminate the step up in basis for capital gains taxation. So if you think about it, right now, if you leave your house to your child, they get a step up in basis. So if you bought the house for $200,000, now it's worth $1 million. They wouldn't pay taxes on that gain. They would simply the step up in basis would move to $1 million. And if they sold it right away, they would pay no taxes on that. This plan would eliminate the step up in basis. So all income wealth transfer would be taxed. That's a big difference. And then on the bottom, the estate tax. Right now, the estate tax exemption for an individual is about $11.7 million, and for a couple, it's a little over about $23 million. They would decrease that down to $3.5 million for an individual with a top tax rate of 45% on anything above 3.5 million, and also lower the lifetime exemption to $1 million. Which right now it's much higher than that. And again, any appreciation in assets would be taxed at death, regardless of where the asset is sold. So meaning if your net worth is $4 million and none of it's left to charity, it's all going to be taxed, and then what's left will go to heirs. So we're keeping an eye on this. If some of these or all of these go into that $3.5 trillion bill, that will have a huge impact on certainly physicians and net worth. Last, I just wanted to mention, if you're interested in hearing more about the Biden agenda, we have a wonderful panel coming up with Larry Myers, Jim Langenfeld, and our own Stephen Fazzari, who's the distinguished professor of economics at WashU. They're going to be talking about this, talking about inflation, talking about interest rates, talking about the Biden agenda, and what could happen as a result of that. So save the date. If it's something you want to come to, just let us know. We're happy to send you the invite. Here's my contact information. Always happy to answer questions if there's things you want to talk about privately, or just a question that you don't want to throw out there now. Happy to do that. Our office is really a resource for people to help answer these questions. All right, with that, I'll if there's any questions, I'm happy to take them. I'm not sure if we have any in the chat or not, but Brigitte, do we have any?
One came through the chat, Russ, and
Okay.
it's can funds from a 401k or 403b plan be given to charity tax-free, or do the funds have to come from an IRA?
Yeah, no. Any of those funds can be given to charity, and so if it's in an estate, it's just a beneficiary designation. You would just list the charity or charities as a beneficiary designation, but that money can be donated to charity. Yes.
And then also any disadvantages of rolling these plans over to an IRA?
Yeah, it's a great question, and certainly I would always suggest you contact your accountant. But there are reasons to do that. So if you're in a low tax environment, if you have a significant tax event this year, or you're making a significant donation this year that will offset the taxes you would pay, you certainly could roll over your IRA. So for example, I've worked with a couple of donors who have rolled over an IRA this year because of the 100% deduction for cash distributions. And so they'll roll over the IRA, they'll make a donation to charity with cash, which will help offset the taxes they would pay on that rollover. So again, that provision is going to end this year, but certainly there are donors and individuals who have done that to roll over the IRA. I mean, obviously, when you roll over, you're going to pay ordinary income tax all up front on that. So it really is a question of where you're at with your taxes that year. Have you made significant donations that can offset it? Is this a year in which your tax rate is lower and it may make sense to do it? So there's a few scenarios where it does work.
Okay, we have another question. In addition to IRAs, can real estate be put into the trust?
Yes. So real estate is a wonderful way to fund a charitable remainder trust, especially during lifetime. So we have a number of donors who will donate a second home or something they don't use anymore. It could be an apartment building, could be a property they rent out. WashU, the base of the property is donated to WashU. We take care of everything else. And the nice thing is your tax deduction is based on the appraised value of the apartment, not what we sell it for. So in that case, we would take ownership. Let's say it's a second home in Florida. We would take ownership. We would sell it, so you don't have to worry about selling it. And you get, one, you avoid capital gains tax on a second home, and two, you receive a tax deduction. So it's a really double positive in that way. And then that once it's sold, that money can be put into a charitable remainder trust. And if it's during lifetime, it can be paid out to you or your spouse or both of you, or to a family member until their death. So real estate's a wonderful way to fund a charitable remainder trust. And then certainly in the estate, a piece of property can be left to fund a testamentary charitable remainder trust. All right, Brigitte, any more questions?
Yeah, there's another one.
Okay.
Can your kids direct the donations at the end of the 20 years in the unit trust?
Typically it's set in the trust document what charities will receive the end payment. I haven't seen it done another way. It doesn't mean it can't be done, but typically the parameters are it goes to, like, so for example, you could say I want to leave 20% to WashU, 20% to Goodwill, 20% or 60% to the Salvation Army. And then within that, your kids could help direct maybe where that money goes. That certainly is a possibility, but in most cases, the charities are set in the trust document.
Okay, unless anybody else has a question, I think those were the only ones that came through the chat.
Great. Well, all good questions. I know you're all very busy, so we wanted to get through this quickly and provide you with the information. Again, we're always happy in our plan giving office to answer questions. Hope you found it informative today. If you want to join the roundtable panel in October, please reach out to us and let us know, and we'll send you the invite. Otherwise, have a wonderful day, and we hope to see you again soon.